meet Morgan and Jeanette last week in Vegas. You know, I only got home at 1 o'clock this morning. Um, Boy, I flew through JFK, and that was quite the. I won't do that again. I'll just fly direct into Philly. Actually, we were coming into JFK. I thought it was one of those amusement rides because they kept having the planes do all these crazy dogleg turns. Apparently, because the wind, was so bad. All right. So loud and clear my audio. Thank you guys so much. Now here is my next question. Can you guys see my screen okay? Is my screen coming through mighty fine? All right, Will, Cesar, Morgan. Okay, thanks, Jeanette and Glenn and Dwight. Well, okay. My name is Ron Haydt. I am from Market Tamer. I've taught thousands of people all over the world, all over the web, how to be successful traders. And what Gareth and I do, Gareth's my business partner, we love helping folks and making a difference in their trading. You know, one of the things that people ask is, how did I get involved in trading? And I always forget to tell this story, but I was actually with my father having lunch with him, and he, and this is going back probably 15 years, and basically he had $10,000. And the broker, which there's nothing, you invest money, you can lose money. That is life, and that's, you're going to see on the disclaimer on the slide next, that is life, right? But he went from 10,000 and got down to about 4,000, and my dad's like, wow, that was all, all of the money to play in the stock market, that was the budget. And so he calls up the broker, and he says, hey, I have $4,000 left. I'd like to know what to buy next. And the broker said to my father, because he was on speakerphone, and he said, if you don't have $5,000, I'm not talking to you. And he hung up on my father. I was just completely, was it flabbergasted is the word? He's lucky he wasn't standing next to me for his own sake. So, my dad lost 60% of his money. There was nothing he could do, and the broker wouldn't help him, blah, blah, blah. And that was the point where I went down the path of trying to learn how to trade the market and how to make it understandable in a way for folks that, have 401ks or IRAs or their hard-earned savings, and they don't want to lose it. And, nobody's going to take care of your money better than you. You'll put yourself first. So that's ended up how Market Tamer became formed, and we truly do enjoy it. I know what it's like to be on the other end, and when I tried to learn options and learn how to trade, I bought so many different courses, and everybody made it so hard to understand. No one made it simple. It's like, really, do you have to do all this research, or can it be made a little simple for everybody? So what I'm going to do is, in our presentation today, we're going to talk about fixing broken trades, because it's one of our most popular topics. It's there we go. It's one that we get asked to present a lot, and yet it's the most widely covering topic, if you will, that everybody can take home today and say, you know what? I can actually use this in my trading. I will actually understand when a trade goes wrong. I do not have to panic. If I own stock, I know exactly what to do and when to do it. And it's simple, it's actionable, and like I said, you're going to take this home with you guys. So it's no secret, and it allows you to sleep at night as well. All right, hey Morgan, what I want to do is I want to give you guys something free as well, and it talks to expectancy. And Morgan's going to put a link in there, and you guys can click on it. You can access the free report. There's no catch or anything like that. And what we're going to talk about as we go through the presentation is some expectancy and the importance of knowing when expectancy changes, and how that how that can negatively impact your portfolio if you're not prepared for it. So instead of making you guys wait to the end, Morgan's like, hey, can we give this to our people up front? I can't say no to Morgan. So you guys got it right out of the gate. So feel free to, it's a free report. You can go ahead and grab it. All right. So I've done the intro. You know who I am. So let's talk about fixing broken trades. And I love these slides. These are my absolute favorite. Accidents happen in real life, right? That's ouch. That could be a bad day too. This is for the gentleman out there, and I don't want to stay on this slide too much longer, but I, I guess you'll walk with a limp after something like that. But this one's for my wife because we have cats, and it's been made keenly aware to me that if there was ever a fire, I would be on my own, and all the cats get saved first. So we're as traders, right? We love to trade. I love to trade. And stock market accidents are going to happen. And no matter who you are, no matter how long you've traded, every once in a while, you're going to make a mistake. It's inevitable. And sometimes the mistake isn't even your fault. It could be something else. It had nothing to do with you. You could have done all the fundamental research in the world, all the technical research in the world. But sometimes things happen that are out of your control. And the ability to hedge your risk, the ability to not panic in a downtrend, but actually become a cheerleader and root for that downtrend, that's a different frame of thinking. So we don't care which way stock moves. But when it does move and we own stock, there's things we can do to protect ourselves, and we do not have to take those losses. So one of the stocks that we get asked a lot about was Facebook. Tesla has sort of replaced it a bit, but Facebook, Tesla, now Twitter are the big hot ones. And our members, when Facebook became public, they were like, hey, you guys talk about fixing broken trades. Let's do Facebook. It was pretty much, everybody knew Facebook was probably going to go down after it came public, just like Twitter, because the valuations were, I don't think we can call them valuations. I don't know what we would call them. Like drinking the Kool-Aid? I don't know. But our members kept asking, come on, you talk about doing this, let's do this. So they said, hey, buy Facebook. So we said, listen, we will, but give us a little time. So we said, we just can't buy it on the first day. That's just silly. And the same thing happened to Blackstone. These were supposedly some of the smartest folks on the planet. Well, their stock got whacked. It got cut in half by, it was like 70 or 80, 90% at one stage. It was up above 35. It went down to as low as 5. It's since rebounded, but that's the point. This was supposedly the smart guys, right? So when Facebook did indeed come public and it hit 45, we didn't buy. We said, oh my gosh, you just can't buy. Then it went to 40, and then we got more emails. Then when it hit 35, the floodgates of email opened. Our customer service team, Misty, was like, did you just say buy Facebook or something? You're getting all these emails. People wanted us to buy Facebook. When it got to 30, we finally said buy. Well, as you guys might remember, if you watched Facebook, we finally caved in and said, we really don't really want to buy Facebook at 30, but we just will. It's at least come down from its highs. Let's establish a position, blah, blah, blah. So, we were wrong. The stock dropped another 33% in just days, and then it was down over half from its IPO. Facebook basically became faceplant, right? I think the slide here is stuck. Hang on a second. There it is. So Facebook became faceplant, and I apologize if you heard my cat. I was in Vegas a week, and now the cats are like Velcro. You see that TV commercial where the cats are on the people's shoes, and it looks like Velcro? That's how these cats are. But anyway, Facebook became faceplant. 44, 45 bucks, all the way down to 22. Now, it's since rebounded, which is cool, but people holding that stock during that time, they were not happy at all. They were sad Facebooks. Now, here's the thing. Even though we were 100% wrong when we bought that stock, we knew going in it was probably going to keep going down, but we wanted to track it. And you might say, well, why would you do that? Because we can pretty much guarantee, well, I can't say the word guarantee, right? But pretty much know that we can turn any loser into a winner, and that's what's key. We've done it before, we've done it in other stocks, but we did one with Facebook. Now, the one we're going to use tonight is another stock that we did it on. I'm going to walk you through that. So whether it's Facebook, whether it's XYZ, it doesn't matter. We know that when we buy stocks, even if we think the fundamentals are right, even if we think the technicals are right, or maybe it's a stock we just don't want to sell because the tax consequences might be too great. It was interesting because I was just chatting with a member in our chat room tonight, and they said, do you think people are going to be selling at the end of the year? And I said, well, I can guess as good as anybody else. I don't mind sharing my opinion, but I don't know that I'll be right. But If the market is still holding together by the time December comes around and we don't have any major sell signals, if you had a cash account, let me ask you guys a question. Would you want to sell before the end of the year or after the year? If you've been just long the S&P, long the Dow, long the NASDAQ, would you want to sell on December 31st or maybe wait to like January 3rd? Anybody have an idea why? Now, I'm not giving tax advice, but I just got to ask, hypothetically. I would so much rather wait and sell at the beginning of the year because the government already takes enough of my money. So if the market's holding together and we don't get any sell signals, if I wait to the beginning of January, I don't on a cash account, I don't have to pay the government. So I don't know if we're going to have any profit taking. I mean, we may have some, but with all the money flowing into this market, there's a lot of different reasons it keeps increasing. So no, I don't know that there will be a sell at the end of this year. I'd say it's 50-50 at best and maybe not even one. But here's the thing. What if it does happen? And the person said, well, what if it does happen? What do you do? I'm like, you know what? We're going to use a simple plan. When we start getting sell signals on our portfolio, on our stock, there are things we can do to hedge our risk and sleep like a baby every single night. It's that simple. So the point I want to drive home and make sure I drive it home is if you yourself have an accident, right? You hurt your leg, where are you going to go? You're going to go to a doctor. Why? Because they have a plan to make you better. If your pet has an accident, where are you going to go? The vet. Vet has a plan. But what are you going to do if your stock market has an accident? So whether it's a mechanic fixing a car, a pilot flying a plane, you got to have a plan because when something goes wrong, you can't be at 35,000 feet saying, uh-oh, now what do I do? You can't have open heart surgery with a doctor saying, what should I do next? The point is that when something bad happens and the stock begins to turn down in this case, we must have a plan to fix it. Because what can we literally guarantee? One day something's going to go wrong. It's inevitable. Just like I said, would you really let the pilot fly a plane without knowing what to do if something went wrong? Would you go to the doctor, open heart surgery? No, you wouldn't. You'd make sure they have a plan before acting. So why would you risk your hard-earned nest egg, what you've worked your whole life for, and then be a deer in the headlights and not have a plan for when it goes wrong? You owe that to yourself. The reason you can be sure things will go wrong because no one has that crystal ball. It's inevitable. And like I said earlier, you're going to do all the research, technical, fundamental, it doesn't matter. But something can go wrong. Once you admit to yourself that, you know what, I'm not going to be right all the time. Every trade I place will not go in the direction. But you know what? I'll also be okay with the trade going in the wrong direction because I can't fix that. You can't prevent that. So when you embrace that fact that not every trade will be right, you're not the worst trader in the world, but we're going to have a plan. And if we implement that plan, when A happens, we'll do B. When B happens, we'll do C. We're going to be able to control greed. We'll control fear. We can trade more like a robot. And then think about that. Think about all losing trades you've had. I've had losing trades. I'm not perfect by any stretch. But imagine if you could take that last $1,000 loss and turn it into a winner. Think about what that would do. The difference it would make in your portfolio. That's a $2,000 swing. That goes from down 10 to up 10. Imagine how much extra money you would have if you could turn every loser into a winner. It would be huge. It would absolutely be huge. And we're going to show you that. So I say it's better not to lose, right? We all know that. But how do you do it? And what do you do to be able to fix that broken trade? Two things: patience and discipline. We got to have the plan. No athlete became successful by training over a weekend. You can't win a marathon by running a whole lot Saturday and going for it Sunday. No one's going to get rich overnight. And while it is possible to get rich overnight, the amount of risk that you'd have to take on to make those kinds of gains is just huge. And more often than not, you're going to lose. So the approach that we want to take is we don't need to capture every dollar the stock moves. We just want to make the right decision at the right time with probability and even expectancy on our side. And the old saying that a jug is going to fill drop by drop is important. We're not looking to make $1 million on a $5 stock. If we have stocks that we own, we don't want to sell them. They're long-term holds, or even it's a stock you bought today and you thought you might hold it till Christmas, till the holidays, but then it goes down a week later. There's things we can do to protect ourselves. In the following example, we're going to show you literally a stock that we were tracking. We bought it and it went wrong. Not a week, the very next day. You're going to discover how to take a loser and turn it into a winner. We're going to show you a path that's clear, easy, repeatable, step by step. You can take it with you, take it back to your stock and say, you know what? I can use that as well. So here's what we're going to do. We're going to fix a broken trade the market tamer way. Now, as I get into this is a very simple approach that's going to affect the most people. As I go through it, it's okay to have ideas in your head and say, huh, he could have done that too. And you're right. Some of you guys that are very option savvy are all going to have some other ideas popping into your head. And you're going to say, oh, well, we could have done that. We could have done that. That's right. I'm going to take a very straightforward and simple approach. There's small variations we can make. But in the end, it all gets us to the same place. So as I go through this, you can ask questions, but please don't be offended if I don't answer your question, because I don't want to lose the flow of what we're going to do. And then at the very end, I'm definitely going to have lots of time for Q&A. So go ahead and get a pencil and paper if you want to jot down some questions, and then I can go back to that slide if necessary, and we'll go ahead and work through it and do the math. So here we go. We're going to fix a broken trade the market tamer ways. All right, here is XYZ stock. I'm not going to give you the name. Stock was purchased 72 bucks a share. That's the white circle, and it's the candle all the way to the right. Very simple. So we've done the fundamental homework. Maybe we like this company. We think it can appreciate considerably, which is hopefully the reason you have the stock in the first place. We don't really want to buy a stock and watch it go down, even though we can fix it, because we could just buy long puts and make money that way. But when all of us here, I think we can probably agree upon that. Every single person. You buy a stock because you hope that turkey's going to go up. And if it doesn't, well, then we'll act. All right. I told you I'm going to keep this simple. I'm going to use, for demonstration purposes, a 5-day exponential moving average in blue and a 20-day exponential moving average in red. We could use an 8-day, use a 25-day, a 13-day. We could use Fibonacci numbers. We could use all sorts of things. And one might be better than another. And some moving averages are going to work better on some stocks. So this is not the golden rule of all time, but it's one that works pretty doggone good and one that you guys can use as well. So keeping it simple, the 5-day EMA and the 20-day EMA. Now, one other tidbit that might come in as we go. You might be asking me, why are we using exponential moving averages? Why not simple? And here's my answer. When a stock is moving, day by day, if you use a simple moving average, and it's 5 days or 20 days, every single day's movement receives equal weighting. So what happened on day 19 is equally as important to what happened today. I want to use an exponential because that's not the case. The most heaviest weighting is given to the most recent day. Because if the stock had a bad earnings report or a bad news event, a downgrade, whatever it might be, maybe they missed retail sales, that's the most important data to me. Sure, I care what happened 4, 5, or 18 days ago, but I just don't care as much. So for short-term moving averages, which are what these two are characterized as, I want to use EMAs. The 50-day and the 200-day that you hear about, simple moving averages there are fine, just because there's so much data in them, it just becomes a flat line anyway. All right, so I told you this was easy. A simple a 5-day EMA and a 20-day EMA. Well, guess what happens? We bought that stock that white candle. The very next day it goes down, 3 more days down. Now the blue line is crossing through the red line. I told you it would be simple. So with the stock around 68 bucks a share, we're going to buy some long put options. We're going to buy one long put for every 100 shares we own. So if you have 300 shares of Pfizer, you buy 3 long puts. We're going to buy these long puts at strike 70. And we're going to pay about $5 a share. And we're going to buy about 3 months in time. I just want to keep this simple. Stock purchased $72 a share. Strike 70 long puts cost $5 a share. So what is our cost basis, or our cost basis in this trade? It's now 77. You take 5 plus 72. What is our risk? What happens if this stock turns out to be the next Enron? Well, the stock would go to 0. But when you have a long put, it gives you the right to sell your stock at that strike price. So we can sell our stock at 70, and now our risk is a mere $7 a share. Very, very little risk, and we can still sleep at night. This is otherwise known as Cesar just said, a married put strategy. That's correct. We are not going to do covered calls yet. Now we don't care if the stock drops. And when I show this to folks who didn't understand options before, and they went through WorldCom and Enrons, even folks trading Tesla now, it literally is a huge light bulb moment that when those sell signals occur, you don't have to be a deer in the headlights. Let's buy a long put, and as the stock moves lower, we can become the biggest cheerleader. Oops. There we go. Sometimes it's sticking here. All right, in this chart, the stock bounced off the same level where it bounced previously. Just look. All the way on the left, you have a little white circle. Then we have the circle in the middle, which was where we bought our puts. Then you have the circle on the right, which is where our stock is sitting right now, assuming this was today. We own stock. We bought it at $72 a share. That middle circle is where we bought our puts, and the stock has dropped considerably. In fact, the stock has gone from 72 to about 58. So here's my question. So here's my question, hang on. Would you sell the long puts or not? So gang, I'm assuming you can see my slides because I did a slide check earlier and the majority of folks replied they could see my slides. I need to do another check. Can you see the slides on the screen? There should be 3 white circles. Okay, we have a problem. All right, I think I might need some tech support help. Now I don't know how much. Hey, Morgan or maybe Sanford or Jeanette. I'm not sure. You guys, can you see the slide? You should see 3 white circles. All right, let's do this. If everybody could just stop. I'm going to try moving the slide one time. All right, just give me a second. I just changed the slide, gang. All right. Gang, what I'm going to have to do is, it appears that I may have to log out. There seems to be a problem. Yeah, I don't know what's happening, Jeanette. Apparently the slides aren't moving, so I don't know what they've seen. All right, so gang, what I'm going to do here is I'm going to log out, and I'm going to log right back in to see if that will help, okay? So I know how to do this, so it literally will take me about 3 minutes to leave and come back in. If it goes quickly, I might be back in literally 60 seconds. Okay, I am back. All right, I'm just going to put a dash in here. And please, nobody type until... we'll do a quick recap. What you should see now at the top of your screen, it should say a greedy start. Do you guys see a greedy start slide? Okay, fantastic. Super duper. Okie dokie. Hey, we all love technology when it works, right? But at least we all don't have to fly somewhere for this nice presentation Morgan's putting on. So that's always good. All right, cool. So we're back. Yeah, you can't always fix everything, you know? So here's the deal. We're going to speed things up. You should see a greedy start. We bought the stock at the white candle inside the white circle. It literally was the top. The stock began to move down. We bought a long put at strike 70. The stock was at $68. Okay? The blue line is now crossing down through the red line. Next slide. Now we're on the control risk. Do you guys all see control risk? We'll just make sure it's working. We bought the stock at $72 a share. The stock goes and drops $4 within days after we buy it. Like, are you kidding me, right? We buy $70 long puts at $5 a share. Even if this turkey goes to zero, we can only lose $7 a share because we lose the price that we paid for the put and the difference between the strike of the put and where the stock is. So it's real simple. Just take 5 plus 2 is 7. We only can lose $7 a share. Now here's my question to you. I'm going to put a dotted line in. All right? The stock in that center circle, it says puts purchased here, declined considerably to the circle that's all the way on the right of your screen. You'll notice when you look to the left, the stock actually bounced from that point once before. So if the stock dropped from that center circle down to the lower right, $12, your long puts have increased in value. You're very happy about this because if you paid $5 for those puts and they're worth like 20, you're making some moolah. This is great. Now the stock lost value too, though, but that's okay. Here's my question. Looking at this chart, knowing what you yourself understand about trading options, would you sell the long put right now? Remember, you own shares. would you sell a long put? The stock is bouncing at a previous support point. Just give me a Y or an N. Come on, humor me. Let's all play the game. Morgan said that if everybody answers my question, he's buying everybody a trip to Florida. And since Morgan may not be listening, he won't know that I just said that. Oh, Jeanette is. Okay, well, it's good Morgan wasn't listening. Uh-oh. Hey, Morgan. Okay, cool. Well, thank you guys so much for answering, because no matter what you answered, there is no wrong answer. Every single person is right, okay? You're all right. So some of you guys, like Jude's saying, hey, I would sell that put because I want my profit. It's hit a support level. It bounced at a previous location. And those of you guys that know about long puts, you know that when you buy them, stocks do not go down forever, and they bounce, and they can bounce pretty viciously. And you don't want to give up all your profits. So when stocks do actually go down, we want to sell those puts often early so we can make some money. But do we really want to do that in this situation? Because you own shares, and I've already told you that this is a long-term portfolio. This is your hard-earned money. This is your nest egg. This is not the Vegas money. Now, Dimitri has a really interesting point, and I thank you. Dimitri's like, I know candles. You have a bullish engulfing candle right there. You are absolutely right, Dimitri. We do. So Dimitri's saying, or he's at least pointing out that maybe we do want to sell those long puts. Well, I don't know, because both your answers are right, everybody. Yes and no. So let's see what's going to happen. It didn't stop there, did it? It actually went a little lower. If you decided to bank profits from the long put, meaning you sold to close it, you just found out that you are more aggressive by nature. That's all. If you decided to hold those long puts, you just discovered that you are more conservative by nature. The 5-day exponential moving average never crossed above the 20. No bullish crossover was signaled. The stock kept collapsing. That's why I said there's not necessarily a wrong answer. If you're a more aggressive trader, as Dimitri pointed out, as other candlestick traders probably noted, there was a bullish engulfing candle there. But for more conservative traders, the blue line never crossed up through the red line indicating a buy. We were still on a sell signal, and that stock kept moving down all the way down to 50. So anybody that decided to hold those long puts and protect their hard-earned capital that they may have worked all their life for, they're feeling a whole lot better right now because they kept those puts. Now, some of you other folks had really great comments, and we're going to get to those in a second. With earnings imminent and the stock at 50, we do not want to hold strike 70 long puts anymore. Because what if the stock has a great earnings report and it pops higher substantially? That could wipe out most of our put profits. And if I did a survey right now, if we were all looking at each other, and if I asked everybody to raise their hand if they lost money on a put, I bet you every single options trader is going to raise their hand. I get it. But that whole chart that we looked at, the trend was down. It never did give us a buy. But when we come into earnings, it's a whole new ballgame. I don't want to hold those $70 long puts that are worth a small fortune right now, because if the stock pops up, all those profits are gone, and that long put didn't serve me much justice. But the second bullet point says, however, comma, neither do we wish to go through earnings announcement with no long puts, because maybe there was a really good reason for that stock going down. Maybe people on the inside or other people knew. Maybe their stores, if they were a retailer, weren't as full. So just because an earnings report's approaching, it doesn't mean I don't want protection. I just don't want all that protection. I don't want to give back my profits on those long puts. So to resolve our apparent dilemma, we can close those strike 70 puts that are worth a boatload. We're going to bank some profit. But you know what also we're going to do? As David's mentioning, we're going to simultaneously buy to open a new set of long puts at a lower strike price near where the stock is trading, around 50. This is called rolling options, just a fancy little term. So let's assume the worst case scenario in our math here, just so you know that the math isn't favoring the numbers. It's actually worse, so you could do slightly better. So assume the worst case that the value in those long puts that we bought up at strike 70 is all intrinsic, meaning there's no time value on them. They're only worth what they're worth. We paid $5 for those puts at strike 70. The stock's at 50. Those puts are now worth 20. That means we profited 15. We buy for 5, sell for 20, we make 15. We made $15 as that stock dropped. Now you might say, but wait a minute, the stock went down like $22. Well, I don't know about you, but making $15 in a stock that's dropping beats the heck out of not making a dime. So we've made 15 of the $22. I think that's pretty good. And then think about, why do you own this stock in the first place? Don't you own this stock because the fundamentals in your eyes are good? Every fundamental stock out there, every stock out there that has great fundamentals does not go up in a straight line. There's ebbs and there's flows. We just want to capture the wiggles when we can. So we're up 15 bucks. I'll tell you what, I'm pretty happy right now, because if I was the old Ron who just bought stocks and never understood how to protect himself, I'm down 22 bucks and I think I'm the worst trader in the world. So let's talk about our new cost basis. The old cost basis was 77. The cost of the stock, 72, and the price of that put 5. Okay, so it is actually 77, right? What's our new cost basis? 72 minus $15 for the profit, and that new put's going to cost us 3 bucks. So our new adjusted cost basis is 60. I understand the stock's at 50. It still beats the crap out of not doing a darn thing when the stock was up at 72. Well, guess what happens? All you long put traders out there, raise your hand. Inevitably, you know what's going to happen, right? The stock's going to go in the opposite direction. It's like Murphy's Law. But we were prepared for it. We moved our puts from strike 70 all the way down to the bottom of that chart. The stock gapped up on earnings, and in fact, it stayed up. The long puts are essentially worthless now, but we only paid 3 bucks. So we only gave back $3, but the stock went up about $10. Now look what happened if we take a larger view of this trade. Go all the way back to the left where the yellow arrow is. We bought the stock, crashes. We roll our long puts down, strike 50. The stock then goes back up and then goes higher, pulls back and then goes higher again. It's back up to $72. Shame it only took like 6-8 months to do that. But we could ride this stock all the way up. The blue never crossed the red. Sure, it pulled back a little bit, but it kept going higher. Really simple stuff. Now let's do a comparison. If you're a buy and holder, which many people are, you're break even after holding the trade for many months. Let's back up a slide. One more time. We bought where that yellow arrow is, white circle. Stock crashed. What were you thinking? And you don't have to write this down unless you really care to share your thoughts, but you have to keep it clean. What were you thinking and what were you saying to yourself as that stock just collapsed from 72 to 50? And then you're coming into an earnings report. Would it be fair to say that some of you guys are thinking, oh my God, not again. I am selling. I do not want to watch this stock get cut in half. I'm an idiot. I'm a bad trader. I just don't want any more pain. Stock trading is not for me. And by the way, I've said many of those things to myself, but I'm just going to be bluntly honest and brutal. You're like, are you kidding me? It's like the worst job ever. Like, you're like the worst timer ever. You literally bought the high, and then if you sold before earnings, you caught the low. And then the stock goes right back up to the highs. It's like, really? Am I cursed? But if you just follow some simple rules, some simple plans, the stock begins a sell signal. Let's buy some puts. It comes down to earnings. We adjust our puts. Stock gaps up, runs higher, goes back to the old highs. Anybody that didn't understand what a long put was and they were holding these stocks, they probably were not sleeping at night. They probably were losing their hair. And as Morgan and Jeanette can tell you, I can't afford to lose any more hair. There's not much left to go. But it's the idea of going to bed at night not having to worry. It's just a simple long put option. You can go to bed. We adjust for earnings. The stock goes up. I understand the put lost its lousy $3, but that was the insurance policy. You insure everything else. You insure your car, if you have a boat, if you have a four-wheeler. There's a lot of things you insure, but why don't people insure their stocks? It's very, it can be done. So the buy and holders, they're just thinking what? Oh my gosh, just get me out. I'm just going to sell now. I got my money back. I can't believe it. Whew, thank goodness. The folks that understand option trades, what are they doing? They're going to be making money. So instead of being break even, they're going to be profitable by $12 a share. If you own 500 shares, just to put it in perspective, that's $6,000. You did $6,000 better than your neighbor. And the buy and holders just got older. Your risk was always low. Your risk was always predefined. The keys to the trade include simply following the rules. We don't panic on downtrends, and we recognize that gains are not made overnight. We're not worried about capturing every dollar for dollar move. We just want the probabilities. On this chart on your screen, the green arrow, we purchased the long puts. I'm sorry, the green circle. The very bottom of your screen, we rolled the long puts down. The stock then began to move up. And look where it went. It goes from not only back up to 72, the stock goes up to 90 over the course of the next 4 to 5 months. You never had to relinquish your shares, but no matter what stock you buy, it's never going to go up in a straight line, even if it is the most fundamentally amazing company out there. There are ebbs and flows, and when those ebbs and flows happen, we don't care about making dollar for dollar, but we don't want to lose our behind. And in fact, we can actually capture most of the movements. Not every dollar, but we can do pretty well for ourselves. So let me say that again. Sleep at night, keep life easy, and still have a chance of making money. That's pretty cool. And every time you wake up in the morning, you don't have to turn on CNBS or anything else to find out that, oh my gosh, your stock got downgraded and it's down 50%. You don't care if you have your long put in place. Is this for long-term traders? Well, let me define long-term, because long-term to you and me might be two different things. These are stocks that you hold in your portfolio, and you bought them with the purpose of them going higher. So if you bought them for 3 months, this could be for you. 2 months, this could be for you. Anything shorter than 2 months, you're basically day trading, which is fine. But think about this for your parents, yourself, your grandparents. It can make a huge difference and not having to worry about panicking. Now, in this example, we only looked at employing the long put option. As Ulian just mentioned, we could actually reduce our risk and increase our profits by using call options. When we got that original sell signal after we purchased our shares, we could have added a simple short call option, and we sell one short call for every 100 shares. You don't have to. You could sell one short call for every 200 shares if you want. But let's just do a one-to-one basis. You sell 3 to 4 month time frame calls. Let's say we just took in $3 a share. That's $3 more you can put in your pocket. And when stocks are giving sell signals, nothing works perfectly. It never will. But the odds, the probability, the expectancy is changing. And the stock is likely to move lower. Not a lock, not a guarantee, but it's likely to move lower. So let's sell a call, put some money in our pocket. We only have to relinquish the shares if the stock comes back higher, and even then we can adjust that position. So we're using a high probability play here, getting a sell signal, we're adding a short call. Well, you know the stock went down, right? It went down to 50. So at that point, we can buy that short call back. It's probably going to be literally worth a nickel, maybe even less if it's traded in penny increments. But we're going to buy that short call back because with earnings approaching, maybe that stock actually goes right back up to that price. There's no reason to leave it open anymore. Let's just capture and take most of the profit off the table. So keeping this simple, when stocks are in uptrends, we don't sell call options because that would limit your upside potential unless they are far out of the money, meaning you sell call options far away from where the stock is trading. In terms of investing a lot of capital, when you own stock, your capital is already invested. So if you have stock in your portfolios already and you see these sell signals occur, you can protect yourself. And adding a long put option is just a fraction of the cost of owning shares. Keeping this simple, you know I keep saying that. We have two rules of thumb. When a stock is in a downtrend, we like to sell calls against our shares. It's a high probability of play. When technical levels fail on your chart, we also like to sell calls against our stock because the likelihood of a stock trending lower is high at that stage. Not rocket science. For those of you guys that are active options traders, that are very good technicians, we can also sell calls during uptrends. But I don't want to get into that. It's going to make things more complicated. I'm giving you returns that can be made by just keeping it so simple, you're not over trading at all. And then always, prior to earnings, we buy back those short calls, so our profit potential remains unlimited. So let's just do a quick recap. Selling calls, in addition to the married put, means our percent return on risk increases because our risk per share is actually going to decrease. Because as we short calls against our stock, we're being paid that premium. That premium goes in our pocket. Nobody can take it from us. And if more money's going in your pocket, your risk per share is dropping. So only by shorting one call that whole time, and like I told you, we could have done better to make these numbers look even prettier. We didn't do that. By shorting a call just one time, we took in that $3. We also made money on the put. We now made $7,500 on 500 shares. Our cost basis is now down to 57. The stock's up at 90. It's a great position to be in. We never had to be that deer in the headlights, buy and holder, buy at 72, watch it crash, then watch it rise and say, thank goodness the stock god smiled, and then you just sell and you don't make a dime. So now you know how to fix a broken trade. Super simple, easy. When a stock that you own, that you want to keep for a variety of reasons, goes against your expectations. You don't have to be a deer anymore. And being from Pennsylvania, we have a lot of deer. So beyond the simple and yet powerful strategy that I just demonstrated, there's also other amazing, powerful techniques that do exist to maximize gains and minimize losses. And that's what we do at Market Tamer. Whether it's spread trades or stock positions, we can teach you guys how to adjust a trade. Very simple, or we can get really advanced. It depends how far you want to take it. So some of the trades that Gareth and I love to do are the credit spreads because you're selling time. Just like selling calls on your stock. You know, bull put spreads, bear call spreads, we love them. Covered calls, they're fine. Collar trades, those are fantastic. We can even do ratio back spreads. We can even do the three-legged inverted hippopotamus trade. When I know what that is, I'll tell you, but it's fun to say. But the one thing you don't have to worry about is mastering every single one. You just take one at a time, you learn, you master it. So if you're new to long put trading, just learn the long put. Just learn how to use that to protect your shares and then migrate into some of these other awesome strategies. Something that Gareth and I put together, and Gareth is the voice you're going to hear on these on-demand training lessons, is we've made them in a format that if you're new to options or if you're advanced, there's material that's covered in 40 lessons that you guys can learn. You can learn about what is a long put. How can I use it to protect my shares so inevitably when the market does turn lower, you can capitalize on it. You know, one of the strategies we talk about are simple covered calls. Now, I'm willing to bet the majority of folks here tonight, or maybe half, you guys understand options. Maybe some other folks do futures or Forex, but they might own stock too. So even if you're a newbie, someone who's just learning options, just understanding how to put short calls against your stock can put one in your pocket. If you own 500 shares of Apple, it's $7 grand. We also talk about income trading because there's 3 certainties of life: death, taxes, and theta. And one of the things that you guys definitely want to do is understand how to sell premium and how valuable that can be to you. You know, I talked about shorting calls against stock, but if you learn how to do credit spreads and you just let time pass and you don't care which way the stock goes except one direction, you no longer have to be directional and say, that stock must rise for me to make money. How about I teach you a strategy that says the stock can rise a little, take a siesta, even go down a little, and still make money. There's also in modules 9 and 10, the adjustments that we spoke about. What I gave you tonight, I can't stress enough, is super basic. We could have put some other awesome indicators in there. We could have added some other analysis. We could have used different time frames. There's so much other stuff we can do. But my point tonight was you don't have to take it that far if you don't want to. But modules 9 and 10, they talk about adjusting. They can show you how to get in to fix virtually any trade. Not every trade can be fixed, but the majority of them can. So there's 2 opposite philosophies. You can take losses, move on, and take more losses. Or learn how to fix losers and turn them into winners. And we used a stock trade that could have been a loser. And I bet a bunch of you guys would have sold at the bottom and I wouldn't have blamed you unless you knew what a long put was. We also have quiz questions. You guys can take a quiz, see that you're learning the material in our videos, and it actually tells you what you missed. We also have market forecast videos that you can get access to every Sunday. I do a video, and it's complimentary to our members, and you guys get access to that as well. You also get access to our stock chat in addition to the videos. And you can put your questions in there if you have, hey, is this stock in an uptrend or is this stock in a downtrend? This is the trade idea I have. Hey guys, what do you think? You'll also get access to our Wealth Path coaching. The offer I'm going to have for you is absolutely amazing. I already talked about the live Market Outlook webinar. And you're also going to get access to 2 additional live coaching calls per week with coaches that actually trade the market, including the gentleman that runs our live trading room. So when Morgan asks us to come in, or asks me to come in, he always asks for a very special deal for his members, for his readers, his viewers. So you guys are getting the kitchen sink. I kid you not that if you tried to acquire these things that I've just quickly talked about, you would actually spend individually over 10 grand. You guys can have access for 14 days, 14 bucks. And they'll put the link in there for you any moment. And there's a bunch of people here, but I have to put some sort of cap on it. I can do as many as 50, even though I think there's like 500 people in here. I can't take 500 new clients at one time. So, you know, it's because you're getting a live component. It's that simple. You're going to get 40 on-demand lessons. The stuff that I showed you today is covered in those lessons. You then get 3 live coaching calls a week to learn options. So it's super, super, the amount of value you're getting is just that good. It's $14 for 14 days. It's $97 a month thereafter. You will be grandfathered in at that price when you take the trial. Next year, the price is going to be changing, but that will not affect you whatsoever. In order to cancel, all you do is write us an email, and this is how easy we make it. You just send me an email before day 14 and say, hey, Ron, thanks, but you know what? It's not for me. I'm busy. You're this, you're that. It doesn't matter. We stop your subscription. No strings attached. But typically, when you think about how simple the strategy I showed you was, you take that and then go back and look at your stocks and you say, holy cow, if I only knew that then, how much money that could have saved you. Don't even worry about making the money. Just look at the money it could have saved you. And it's truly amazing. And when I do these events live and I teach this, we'll be able to look at some stocks that you guys have brought with you, or if we have a live internet connection, and it really is stunning. So we can make this a lot more in-depth. We can talk about different moving averages. I know a few of you guys were asking, hey, why do you use those moving averages? Well, here's what I would say. The 5 and the 20-day EMA are the most common moving averages that'll work on the most stocks. But what you might find is, let's say you trade XYZ, you might find that the 8-day EMA works well with the 20-day. And certain traders will trade certain stocks differently. So if you see your stocks sort of following those moving averages, I strongly recommend you just tinker with it just a little bit, and then you're going to find that moving average that works. But that's how simple. It doesn't need to be that complicated. Very, very straightforward. So if you guys have any questions, please do ask. I will answer every single one you guys throw at me. We have about 4 minutes or so. Could we do diagonals? You could. Julian, the diagonals can be, I call it the poor person's stock ownership, and I do like that. Because if you think about Google, do you really want to outlay $1,000 a share? Whereas you could do a diagonal, buy an in-the-money call, and treat it the same way. You won't get a dividend if one is paid, but it is a way to actually lighten the amount of capital. All right, hey there, Denny, how you doing? In live sessions, you're going to be with me live every Monday night. You're going to get a live video from me every weekend on the Market Outlook. The other 2 live coaching calls are folks that I work with, I have trained. They've also mastered trading on their own as well. You'll have access to them twice a week. And the actual videos are done by my business partner, Gareth. He recorded those, and you are absolutely going to love them. All right. Very, very cool. All right, any other questions? I still have a couple minutes here before Morgan takes over. Maurice, in terms of implied volatility, that's a very good question. Implied volatility will not come into play because we're protecting something that's even bigger than implied volatility. We're protecting our nest egg. We're protecting our investment. So if the stock actually begins to move lower, we don't necessarily care if implied volatility is high. You might now, to some people, that might sound really awful, counterintuitive. And you might say, well, of course implied volatility plays a role. I don't care if implied volatility was 3,000% or 10,000%. If my stock's at $100 and the risk is it goes to 0, I need to protect those shares at all costs. So one way to help offset implied volatility is if implied volatility is on the high side and you decide to purchase a long put, the fact that you are selling a short call as well when those sell signals occur, you're selling implied volatility at the same time. It may not be on a one-to-one basis, but it'll be pretty close. So that's how we can also offset the implied volatility on the buy side with that long put. So Maurice, let me know if that helps. If not, I can go into a little more detail if you'd like. All right, hey there, David. Let me see when we're on our weekly short call. If you want to use weekly call options against your stocks, I have no problem with that whatsoever. You have to be more proactive. For tonight's presentation, it took the long look approach. That for those of you guys that have stocks and you don't want to sell them for a variety of reasons, even when the market rolls over, those long put options will protect you. They always give you a right to sell your shares. All right, gang, I see I'm out of time here, so I'm going to turn this over to Morgan. The link on your screen, it will be good. Today's Monday. It'll be good to Thanksgiving, because I know you guys already saw a bunch of folks today, and you're going to see people throughout the night. So it'll definitely be good through Thanksgiving. We can even make it Black Friday. Once the 50th trial is hit, it is going to go to sold out, just to let you know. So it's 14 bucks, 14 days. You can jump on it. And then, Morgan, could I ask you just to put in that expectancy report one more time? If you could put that in the chat box, or actually maybe I can grab it here. And then, let's see, actually I can't find it. So if you could throw it in there, there it is. And for anybody that just wants a free report on expectancy, just click on that. There's no catch. There's no sales pitch. You just click on it and you get your free report, because when expectancy on the market turns lower, whether you're trading the spiders or your stocks, you want to be protected. So it's a fantastic report. All right, I'll just type in the phone number. I'm going to hand it over to Morgan. So Morgan, thank you so much for inviting me in. I always enjoy your group. I find these a lot of fun, and it was great to see you in Vegas last week. So thanks again. I look forward to seeing you guys in the next 24-hour marathon. But Morgan, what I think we should do is, I think 24 hours is getting a little short. I'm thinking we should do like 5 straight days. What do you think? All right, I'm going on mute. Hey, thank you guys so much. I appreciate all your questions. And Morgan, thank you for inviting us in. I very much appreciate it.